for 105.5 strike. Call option costs 137 cents. Put option costs 135 cents. So with respect to options, longer expiration dates, higher option premiums. If you want to be protected from the downside, but keep some or all of the upside for 1 month versus 2 months, obviously 2 months is more valuable. Just same thing with insurance. If you have a insurance policy that's going to be renewed in 1 month, they're going to give you a much lower price compared to 2 months. Because there's a higher chance that an accident will happen in 2 months compared to 1 month. For call options, higher strike implies lower premiums. For put options, higher strike implies higher premiums. If you want really long-term protection, you gotta go to your bank and ask for a quote. For longer term options for exchange rate risk management, you need customized products. From your bank. This doesn't have to be literally a bank you're working, but it could be a FX broker, it could be an investment bank. But certain exposures are not that good to be managed with options. Especially if you have recurring exposures. Managing all of those transaction exposures using options becomes very expensive. Think of it this way. Because of your business, every month you're going to get 1 million euro from your customers, and you're greedy. You want to keep the upside, but you don't want any of the downside. So over the next 2 years, you want to manage this risk, and you can go to your bank and say, can I please buy an option for 1 million euro? And let's say current market is 105, strike price at 105. I want above 105, but I don't like below 105. Okay, I'll sell it to you. Then you're going to ask for another one 2 months from now, 3 months from now, so on and so forth. As you add more and more options, they're going to get more and more expensive. Because a 2-year option is a lot more expensive compared to a 1 month option. Let me show it to you on stocks. For example, let's look at this stock, Palantir Technologies. These guys use AI in military contracts, even though I hate the owners. To me, it has a lot of futures. Let's look at the options. Here's an option that expires in 1 month. let's look at the call option, roughly $15. The market is, let's look at the average of the bid and offer. If I pay 84 cents per share, I can get anything above 15, but not worry about anything below 15. All right. Let's look at the same thing for 2 months. Okay, 2.5 months. Oh, that's about double, 169. Let's look at the longest available, January 16, 2026. Oh, that's $6, okay? Exchange rates are not this high because stock prices are a lot more volatile compared to exchange rates, but the longer is the maturity, the higher is the option premium. So you can actually instead of buying an option for each of those transactions, you can buy an option on the average of those transactions. So let's say current spot euro dollar is 105. Over the next 24 months, I can buy what's called an Asian style option, call option. Where I get compensated let's call it X-bar minus 105 if X-bar is greater than 105, 0 otherwise, where X-bar is the average monthly exchange rate over the next 24 months. This actually fits better with my, risk exposure, because I don't particularly care whether I have a lower rate next month or the other month. All I care is on the average how much I'm going to get out of those 24 million euros. So I'm going to go to my bank and say, protect me on the average. These options are much cheaper. Unfortunately, there is no organized exchange for trading these. So you have to go to your bank. In next semester, if you take Finance 424 from me, we will actually cover how to price these things. Turns out the only way we can do it is using some sort of numerical Monte Carlo simulation, but it's doable. You just need computing power. In this day and age of AI, that's not a problem. But even an old laptops that I had in early 90s were able to take care of these. Nowadays, if you're careful, it's not much of an issue. I'm gonna stop here. Today, on Monday, we're gonna start talking about management of economic exposure. Turns out that's a much trickier issue for two things. Calculating the size of exposure for transaction exposure is straightforward. You got $2 million coming to you, done. And we have different ways of hedging it. With economic exposure, the real problem is figuring out exactly what your exposure is. Once you figure that out, you can decide what tools to use. It's kind of a two-stage process. So first, we're going to estimate the size of economic exposure. Second, use financial instruments and other business tools to manage that exposure. All right. I'll see you guys Monday.